Who really owns world debt? The hidden network of power, money, and risk that shapes the modern world. What world debt really means. When people hear that the world owes over $250 trillion, it sounds almost unreal. A number so big that it feels detached from everyday life. But this massive figure isn't a fantasy. It's a web of obligations, promises, and power that underpins the global economy. To understand it, we first need to separate the two main types of debt. Sovereign or public debt is the money governments owe, what nations borrow through bonds and securities to fund budgets, wars, social programs, or rescue plans. When you hear about U.S. treasuries or Japanese government bonds, that's sovereign debt. Private debt, meanwhile, includes everything from corporate loans to household mortgages, the debts taken on by businesses, banks, and families. Together, public and private debt form the lifeblood of the financial system, but also its greatest vulnerability. According to international financial data, total global public debt alone has approached nearly $100 trillion, while combined with private borrowing, it exceeds $250 trillion. To put that into perspective, the world owes more than 3 times its total annual economic output. Who actually owns sovereign debt? Now the big question, if the world owes all this money, who's on the other side? Who are the lenders? The ownership of sovereign debt is surprisingly complex. It's divided among a few key groups that hold different kinds of power and influence over governments. 1. Domestic non-bank private investors. These are pension funds, mutual funds, insurance companies, and even households. They buy government bonds as safe assets, a way to store wealth with guaranteed returns. 2. Domestic banks and financial institutions. Banks often buy their own country's bonds to meet regulatory requirements or to have safe collateral for loans. In emerging economies, they may hold an even larger share, sometimes making them dangerously tied to the government's fiscal health. 3. Central banks and government agencies. A large chunk of debt is actually owed to oneself. Central banks often hold bonds for monetary policy reasons, to control inflation, interest rates, and liquidity. 4. Foreign private investors, hedge funds, international asset managers, and overseas pension funds often buy foreign bonds to diversify and chase better yields. 5. Foreign governments and sovereign wealth funds. These are the official foreign holders, countries buying other nations' debt for strategic, economic, or currency reasons. For example, Japan and China hold hundreds of billions in U.S. debt to stabilize their currencies and support trade. Each of these players acts differently during times of crisis. Domestic pension funds may hold through volatility. Hedge funds may sell immediately. Central banks may print money to buy more. The result? A complex, shifting balance of stability and risk. The United States, a case study in debt power. The U.S. provides the clearest window into this system. Its treasury market is the beating heart of global finance, the asset that sets the price of money for the entire world. Out of its massive $36 trillion in total federal debt, about 71% is held domestically, while roughly 29% belongs to foreign investors. The Federal Reserve, America's central bank, is by far the largest single holder. Through quantitative easing, it has purchased trillions of dollars in treasuries to stabilize markets and manage inflation. Other domestic holders include mutual funds, banks, insurance companies, and pension systems. Foreign ownership tells another geopolitical story. Japan is the largest foreign holder with over $1 trillion in treasuries. China follows with roughly $750–800 billion. Others like the United Kingdom, Luxembourg, and Canada also hold significant stakes. Why debt ownership matters. Debt ownership isn't just a bookkeeping matter. It's a reflection of global power. Who holds your debt can decide how much freedom you have. When domestic investors own most of a nation's debt, that government has more control. It can change interest rates or restructure debt without fearing foreign retaliation. When foreign investors dominate, the situation becomes riskier. They can sell off bonds, triggering capital flight, currency crashes, and political instability. This has happened repeatedly in emerging economies from Argentina to Turkey. Moreover, private investors like hedge funds react quickly to bad news, selling at the first sign of trouble. Foreign central banks, by contrast, are slower and more strategic. They buy for long-term purposes, to maintain trade relationships or influence, rather than short-term profits. The hidden dynamics of the debt system. The ownership of world debt also reveals the hidden architecture of the global financial order and the tension between markets, governments, and geopolitics. Liquidity and stability. When a diverse mix of investors holds a country's bonds, the market tends to be more liquid and stable. But if too much of it is concentrated, say, in domestic banks, the system becomes fragile. If the government falters, both the banks and the state can fall together. Currency and control. Debt held in foreign currency, such as dollars or euros, introduces another layer of danger. If the borrower's currency falls, repayment becomes harder and a crisis can follow. That's why many developing nations prefer to issue bonds in their own currencies today, even if it means paying higher rates. Political leverage. Owning another nation's debt can also be a weapon. When Japan or China holds U.S. treasuries, they hold a form of soft power, a seat at the global economic table. Similarly, Western nations have long used debt relief and restructuring as tools of influence over developing economies. Common myths about global debt. China owns all the world's debt. This is one of the most persistent myths. While China is a significant creditor, most global debt is actually held domestically by citizens, funds, and institutions within each country. Debt is a sign of failure. Not necessarily. Debt is also a tool, a way for governments and businesses to invest in growth. The problem arises when it grows faster than income, productivity, or the ability to service it. The world can just print money to erase debt. Printing money can ease short-term pressure, but it often leads to inflation or currency collapse. Central banks can absorb some debt, but not without long-term costs. The shifting global landscape. The composition of world debt ownership is changing fast. Over the past 2 decades, non-bank private investors, pension funds, mutual funds, asset managers have become the main absorbers of new sovereign debt, especially in advanced economies. In emerging markets, domestic banks still play a large role, but even there, the balance is shifting toward private investment funds and foreign inflows. The takeaway, a global web of interdependence. So, who really owns world debt? The answer is everyone and no one. Pensioners in London own U.S. treasuries through their retirement funds. American mutual funds hold Japanese bonds. Chinese state funds hold African infrastructure debt. And central banks from Tokyo to Riyadh hold each other's paper in their reserves. This vast interconnected network keeps the world economy running. The real question then isn't just who owns world debt, but who can afford for it to break. World debt isn't just a financial system. It's a mirror of our collective priorities. Every bond represents a promise, and every promise comes with a cost. Understanding who owns those promises tells us who truly holds the levers of global power. The levers of